Liquidity is the most important concept you need to learn. Everything that happens in the market is because of liquidity. By the end of this video, you will understand liquidity properly, finally bridging the gap between all the other ICT concepts which are constantly being thrown at you, leaving you confused and not sure what to do. With liquidity, you will understand the magnet areas in the market. So if you are not profitable yet and you are taking your trading serious, make sure you pay close attention, as I will be dropping many gems in today's video. Now, to start off, what actually is liquidity? Now, to understand liquidity, you need to have a good understanding of volume. Volume is simply the amount of lots or the amount of orders in a specific time period. Now, many people get this confused with liquidity. However, I'm going to tell you there is a slight difference which you need to know. Liquidity simply refers to how easy it is to buy or sell an asset. So, in Forex, we know it is a financial market. There is buyers and sellers. For us retail traders, most of the time, or nearly all the time, there is never a problem with us entering the market. As we place orders with quite small lot sizes, it is very simple for us to execute our positions. For example, let me bring up an example of buying an iPhone, which I always use because it's quite easy to understand. So if I go to the Apple store looking for an iPhone, and they say we have an iPhone in stock, we are going to sell it to you. Now, they're making a profit off this. They are selling me an iPhone. So for me to be able to buy this iPhone, there needs to be someone willing to sell me this iPhone. And for the Apple store to make a profit, for them to sell iPhones, there has to be people willing to buy the iPhones. Now, this is no different to Forex. Forex is a financial market. There is buyers and there are sellers. If you want to sell, there has to be buyers. And if you want to buy, there has to be sellers. Now, what if I came into the Apple store on a random Tuesday and I asked for 500 iPhones? I said, give me 500 iPhones on the spot right now. Do you think they'd be able to facilitate my request? Do you think they would be able to give me 500 iPhones on the spot? And the likely answer is no. The Apple store probably does not have 500 iPhones in one singular store. What they'd have to do is plan ahead and order iPhones, or maybe get it from other stores, or do whatever they need to do. They would need time to prepare in order to collect 500 iPhones. Now, why am I telling you about iPhones in Apple stores, and how does this even relate to trading? Now, as I said, Forex is a financial market. Whether it's commodities, crypto, whatever it is, there is buyers and sellers. It is a financial market. In Forex, we have buyers and sellers. Now, while it may not affect us, large market participants such as banks, hedge funds, etc., they are placing orders with millions and millions of lot sizes, huge orders which they cannot always execute their positions. For example, let's say a bank is trying to sell EURUSD right here worth of $100 million, for example. Now, for them to be able to sell $100 million worth of USD, as I said earlier, guys, there has to be people buying USD of $100 million worth. If there is not $100 million worth of buyers in the market, they cannot place this sell of $100 million. This is the problem they run into. They are trading with such big amounts that they do not always have the liquidity. They are not always able to buy and sell easily in the market. So how does smart money actually get around this problem? They instigate retail buying and selling. They create market conditions which is favorable, or at least retail traders think is favorable for them to enter. In other words, they simply manipulate the market. They manipulate you as a retail trader in order to take you out of your position to fund their positions. For example, you can see this is a very clear area of support, which would call it. As you guys can see, we have 1, 2, 3, 4, 5 wick touches. So this would be a very strong level of support right here, which we know a lot of traders are buying at. There could be traders here who are still holding their buys, who are aiming for maybe an old high up here, for example. The point being, there is a lot of buyers in the market active right now. Now, smart money can't actually see where the buyers and sellers are at. They cannot see the orders in the market. However, with their understanding of liquidity, they know where to aim. They know where to sweep liquidity from. They know where to drive price in order to take out these traders in the market. With all these buyers in the market right here, there is a lot of stop losses down here. So SL for stop loss. Everyone buying, they've entered their position on the red line, for example. This is their entry price right here, and this is their stop loss. So what does market do from here? What market could do, or smart money is recognized as a high amount of buyers in here. There's a load of volume, as I've said. What they would do is come down, trigger their stop loss before reversing. Now, why does market reverse after hitting their stop loss? You may have noticed when you're trading that market instantly reverses after hitting your stop loss. This is why you may have gotten used as liquidity, but do not worry, after this video it will never happen again to you. All the traders buying here that are now out of the market, so they are out of their buy positions, they have to sell their position. Once you place a buy, if you want to close that position, you have to sell back your position. If you place a sell up here and you want to close your position, you have to buy it back. Now, at what price, if you sell it at a worse rate or a better rate, is whether you make profit or not. That's how Forex works. Most of you guys should understand this. So with all these buyers out the market and now them closing out their positions, them selling their position. So now there's a lot of sell side liquidity in the market. This is why we call liquidity at lows sell side and liquidity up here buy side. With all this sell side liquidity, what can smart money do? They can place a huge buy order. As I said, Forex is a financial market. For them to buy, there needs to be sellers. And what is there? There is enough sellers in the market for them to buy. Now, more liquidity could come from breakout traders. Breakout traders aim to enter once there's a break of structure in the market as such. Once they see a break below these lows, they are placing their buy order right here. So once market comes, taps them in, they are officially selling here. Sorry, they're placing a sell order. So this is a sell position right here, and they're looking to catch the continuation of the market, possibly stop loss around up here and take profit somewhere below. However, what market does is enters them into the market before quickly reversing and taking out their stop loss. What is this? They are selling here, so there is more sell side liquidity for market to reverse. And with the huge orders that smart money is placing, they can very easily manipulate price to the upside or downside. So that's why you see such an impulsive price move upwards or downwards after a liquidity sweep. Let's take a look on the market. Here we are on the 1 hour time frame. As you guys can see, we do have a lot of equal lows forming where market has just swept this liquidity. Now from here, if I play our market, you can see market instantly shoots up, creating a big move towards the upside. Now, this big move is caused as we've swept liquidity. Another example right here, we have these equal lows right here. As you guys can see, we have 3 touches. So we have market come below, sweep this liquidity, and we get a big move to the upside. All the big moves happens after liquidity sweeps, as that's when smart money can get engaged into the market. Another example, we have these highs right here. Market comes above these highs. As you guys can see, market comes above the highs and we instantly shoot down. Another example, we have a consolidating market right here. Market comes above this high right here, as you guys can see, and we instantly shoot downwards. And again, you'll see it play out time after time again. Equal lows right here. Market comes, sweeps these lows, and we shoot upwards. These are the ideal points you want to be entering on the market. So any point where there's liquidity, once market has swept liquidity, that's why we use liquidity sweeps, as it is the ideal point to catch a move in the market. This is when market reverses with a lot of volume. There's 2 ways market can take out liquidity. The first way is running on liquidity, and the second is sweeping on liquidity. In this example, we sweep liquidity as market comes below liquidity, takes the liquidity before quickly reversing. Whereas a run on liquidity is market comes above liquidity and continues above liquidity. Now, these are both valid ways market can take out liquidity. However, in today's video, we're going to be focusing on liquidity sweeps in order to catch the reversals in the market. Now, the reason why I'm solely focusing on liquidity sweeps in this video is because there's more confluences while entering. It is my preferred form of liquidity. So if I want to see market take liquidity, I'd prefer to see a liquidity sweep. One, we could have a PD array, and there is another secret which I'll teach you in the video which adds more confidence towards your trade. Whereas if you are trading a run on liquidity simply, the best way to enter is simply through a fair value gap above the displacement. So here we are in the market again. You can see this clear level of support where we get 1 tap, 2 tap, 3 tap, and hopefully retail traders will be looking for a 4th tap for them to catch another entry. Now, there could be many entries in the market right here, with an entry possibly here, for example, at this order block right here, with stop losses below the low right here, this low for example. Now, traders here will be doing the same thing, placing stop loss right at this low right here. Everyone entering in this market, or most of the market participants, are placing their stop losses below this low. So what does smart money decide to do? Come and take out all these traders in this range right here. Every buyer in the market, or most of the buyers, ideally, I'm sure you guys can relate with this, you place your stop losses below swing lows and swing highs. I do the same. And as you guys can see, market comes, takes their stop loss, and you'll see the move from here is very energetic towards the upside. Liquidity sweeps happen very fast, and you'll be able to identify them very easily. As you guys can see, we have a wick tap out any traders who are active in the market, and quickly reverse. Now, we are not comfortable below this low. As you guys can even see, we have a wick closure and not a body closure, meaning market does want to move towards the upside. Now, within this same example, we also do get a run above liquidity. As you guys can see, we have this high right here, and we do get a body closure above the high. However, market does come back to fill this fair value gap right here, as you guys can see right here. Now, it does not look like your usual fair value gap. However, it is an inefficiency in the market. As you guys can see, it has jumped. So that's for another video, however. But as you guys can see, market comes, fills the fair value gap before, if I play out market, you can see we end up moving towards the upside. We have a run on liquidity. Now, why is this? Firstly, market is pretty comfortable above this high. As you guys can see, we are getting body closure above the high, meaning market is comfortable staying above this high. If you look at this liquidity sweep, market is not comfortable. We have a wick tap and market quickly reverses. However, in this scenario, you can see market is very comfortable above the high, and we do have a bullish fair value gap supporting our move towards the upside. Now, not only do we get the liquidity of sellers on this high right here, who maybe have their stop loss somewhere here, we have them taken out of the market. We also have breakout traders. So any trader trading the breakout here, so a buyer right here, sorry, a buyer. Any trader placing a buyer right here with their take profit somewhere up here, their stop loss down here, they are taken out of the market. We have traders on both sides taken out, first to the upside and then the breakout traders, obviously, before market comes and reverses in its desired direction. When we talk about liquidity, we need to include the candle range theory. Now, we do understand, everyone understands a single candle is a range. If this was a 4-hour candle, this is a range on a lower time frame. If it was a daily candle, it's a range on a lower time frame. Pretty self-explanatory. So this high up here is also a swing high on a lower time frame. Now, we use these candles, we want to go up in time frame to see each candle and how the next candle behaves based on the previous candle, if that does make sense. Seeing how market acts within the previous candle high and the previous candle low. So in this scenario, as you guys can see, we come out to take the previous candle high, and as you guys can see, we get a body closure above the high. What can I assume from here? This is a run on liquidity. Next candle is going to be bearish. Same way I showed you guys sweeps and runs on liquidity, this is essentially the same thing, however on a different time frame. We get body closure above the high, indicating a continuation. In this scenario, this candle definitely shows a range on a lower time frame. It's self-explanatory. Here we have the high of the range or the high of the candle because of what time frame we are on. Market comes, sweeps the candle with body closure back within our candle range, which indicates to me market is reversing. Next candle is going to be bearish. Now, this doesn't only have to be on a higher time frame. Say for example, market is playing within a fair value gap, and you see this first candle print right here, and what most traders would do as soon as we enter the fair value gap is most traders would enter. So there would be a large level of liquidity within this area right here, as because of the fair value gap, a lot of traders are entering. However, what does market do? What does smart money do? In order to liquidate all these traders, we're going to run above this high where there's a significant area of liquidity before sweeping. Understanding candle science in each scenario is vital. If you want to see if market is running or sweeping liquidity, you can check how the candle behaves. If we have body closure, most likely we are running. If we have a wick closure, it shows market is not comfortable above that high or below that low, so we are more likely to get a reversal. Understanding how this also adds as a last point of liquidity for market. Once we've entered our PD area, such as a fair value gap, market will make the last sweep of liquidity before reversing. Knowing this piece of info could save you from a lot of stupid losses. Avoid you being liquidity and actually trading with the liquidity, becoming profitable. Let's put everything I've taught you together and let's use it on EURUSD. Now, this is the most recent example on the daily time frame, which I'm going to show you how liquidity played a role in this week's and last week's price action. Now, if you are in the VIP room, you would already have an idea of what's happened, as I documented every move the market was making through the market analysis. I showed you guys this fair value gap beforehand, the reversal beforehand. I called a lot of these stages I'm about to explain. So let's see what I described. So if I play out market, you can see firstly, we do come and tap into this fair value gap. We have a continuation of 3 candles. We have a sweep of this low with a body closure. Now, from here, we are playing within the daily fair value gap. And if I do hop onto the weekly time frame, you guys can see there's more points of liquidity where market is playing above this old high right here. So we do get a rejection block above this high right here, which market could be reversing from, which if we hop back onto the daily time frame, we can see market has come reverse. We do leave a bearish order block right here, and we are playing within the fair value gap. Now, what I did call is this is not the last move before market starts moving up in its desired direction. I called there will be another sweep of liquidity before we move upwards, which is if we play out market. You guys can see we do get a candle closure below this low right here. If I play it out again, you can see we do get another candle closure as such shown, where market comes, sweeps the low, and we come back into our zone before, if you can see, market does come, we take out the high of the candle right here and we push upwards, which from there we do get the continuation to where market is now before tapping into this fair value gap right here and reversing. Now let's focus on this high that market is playing above, which I showed you on the weekly time frame. How can we identify this as a sweep versus a run? Now, as we know, sweeps quickly displace above a high before quickly reversing, whereas runs are comfortable above the high or low. As you guys can see, market is not quite comfortable above this high. If I hop into the weekly time frame, you guys can see market is not that comfortable. We get one bullish candle above the high, next candle instantly bearish. If I go into the daily, you can see this again. We have a bullish candle, a bearish. Market comes, sweeps liquidity of these candle highs before playing out, consolidating before dropping back down. Now you may be wondering, all these concepts are quite good, but how do I actually implement them into my market to make money, to make profits, to catch trades, which is ultimately the goal of trading? It's all good knowing all these fancy terms and concepts, but if you can't implement it, what's the point? So let me just mark out these equal highs right here, which is a form of liquidity, as you guys know. So what is a telltale sign that we are bullish? We are sweeping lows, we are sweeping liquidity to the downside, and we are forming liquidity to the upside. That is our first confluence. Second confluence, we are sweeping a weekly high. That's our second confluence. Our third confluence, we are playing within a PD array. That is our third confluences. From these three confluences, I know we are going to be bullish. And I can also add a fourth confluence, which is candle closure, body closure above this high right here, our fourth confluences. So these four confluences just tell me that market is going to be moving up. I mean, you could also say something like this fair value gap right here, or this order block. So you guys know it. You have to build a narrative in the market to understand the direction and the bias of the market. So I have my drawn liquidity. I'm going to drop down to a lower time frame, but before I do that, I'm going to mark out the open of the candle. So let's drop down to the 30-minute now, and I'm going to show you guys how you could have caught an entry. Now, if you don't understand candle science, make sure you guys watch my previous video on candle science, which will really help you on candle theory. It will really help you with your entries, such as I'll show you. In that video, I had described the best place to open or to trade if we are in an uptrend is to buy below the opening price of the candle. So if I hop back onto the daily time frame, just to show you guys, and if I play out the next candle, the best place to buy is below the opening price at this wick right here. So let me go back onto the 30-minute, and lo and behold, what do we see? It marks out the order block very perfectly, which is one place you could have bought. However, there's also another order block right here, which we are playing in a fair value gap, which gives us more bullish order flow to the upside. All these confluences add up to build a narrative for your trade. We also do have a point of liquidity up here. So if I play out market, now, price action won't be the clearest due to news and just the amount of news we had last week. But however, you can see we do tap in. We get entry before market does move to the upside, as shown right here. Now, if you did enter on this trade, which I wouldn't recommend for most of you just because of news, entered right here, say you targeted these highs right here, you would have ultimately caught a 1 to 8, 1 to 9, 50 pips, amazingly. Now, it's not the cleanest price action. However, you can see the concepts are clearly working. Let's move on to another example. Let's build up our confluences and see why I took this trade and how a good understanding of liquidity would have caught you this trade, and more importantly, avoided you a lot of dumb losses. Firstly, a bullish fair value gap right here, which we can see market is coming to, which market has actually already tapped into. Let me just replay the market for the example's sake. And we can see market is in a clear uptrend. As you guys can see right here, we are quite bullish on the daily. So to hop down onto the 4-hour time frame, I want to show you a area of liquidity right here where market does form these equal lows. Now, a lot of traders would have been entering here, whether it be retail traders in the form of support and resistance, whether it may even be SMC traders, IST traders. If you had caught an order block here, you may have thought, okay, there might be an up move right here. However, if you let the next candles play out, you would have got taken out just as so. So we've had a sweep of liquidity, and I'm going to explain why it's a sweep we have an uptrend and a bullish fair value gap. Within this fair value gap, there will be a lot of early buyers trying to place buys here as such. So not only does market have the liquidity from these buyers right here, they're also going to take out any traders trying to enter off this fair value gap. So any traders, you instantly enter off the open price of the fair value gap. If we play out the next candle, you can see market comes, sweeps the lot of these candles, sweeps out any traders, takes out any traders of the market who are trying to enter off this fair value gap early. So we get the sweep before getting our actual move to the upside. So if I play out market, you can see we do get another sweep. So you can see market playing out within our area right here. Maybe we are forming more liquidity. So if I drop down to a lower time frame, you can see this is a form of liquidity in itself where we have equal highs and equal lows. However, back to the 4-hour time frame. Now again, where is the best place to enter? It's always at the manipulation. And in our case, where is the manipulation? The manipulation happens below the close of this candle, because here's where the liquidity is. So we know market's going to come take this liquidity before reversing. So if I drop down to a lower time frame, such as the 15-minute, lo and behold, what do we get? We get another very clear order block. However, let me just let it form out. We need a break of structure, and we do. As you guys can see, we get a breakup of these candles before market comes, taps into our fair value gap. And again, if you were to take this entry, stop loss below the low, and for example's sake, if you were to target a 1 to 2, or if you even were to target this liquidity, which market does end up reaching, if I just play out market for you guys, you see we do get a lot of consolidation right here, and market does come smashing our full take profit for 50 pips. Now, the concepts you use and you learn in this video are very fundamental in your trading, as I've just shown you, for your buyers, for your entries, understanding where to enter and where not to enter. If you've learned something useful today, make sure you guys drop a like and you subscribe to the channel for more free content. And if you are looking to take your trading to the next level, make sure you guys check the link in the description for the VIP room. Thank you guys so much for watching, and I'll see you guys next time.